All right, let's jump right into this explainer and trace the fascinating life cycle of the US dollar's dominance. For nearly a century, the US dollar has basically been the undisputed king of global finance, right? It's this invisible force shaping literally everything from international trade to the price of gas at your local pump. But is this reign actually coming to an end? Today, we're going to look at the hard data. We'll track the dollar from its almost accidental rise to power straight through to some brand new economic research that shows a quantifiable, undeniable erosion of its global status. Now, you read a grand declaration like this from the New York Times back in 1944, and it honestly makes the whole thing sound like destiny. You think the dollar's supremacy was this meticulously crafted master plan orchestrated by global financial architects. But when you dig into the historical transcripts, they reveal something entirely different. There was no grand strategy. It was actually the result of a logistical fluke, a simple matter of convenience during a really exhausting negotiation. Which brings us to our first section, an accidental global currency. To truly understand how the dollar might lose its crown today, we first have to look at how it accidentally won it, back at the legendary Bretton Woods Conference. Originally, you had brilliant economic architects like John Maynard Keynes pushing for an entirely new global currency. He called it the Bancor. And up until July 12th, the prevailing plan stressed that the new international system absolutely had to use multiple currencies to avoid relying too heavily on any single one. But then, a rapid, almost totally mundane series of events in mid-July completely flipped the script. It all pivoted on a single, rather dry question. Ardashir Darb-Shahstraf, who was representing the Indian delegation, essentially raised his hand and asked for a precise definition of what exactly a gold convertible exchange was going to be under this new system. This completely mundane clarification question became the happy accident that fundamentally rewired the global financial system forever. Why? Because U.S. Delegate Edward Bernstein basically replied that coming up with a definition to satisfy everyone in the room would just take way too much time. It was going to be a long, exhausting debate, so he suggested a shortcut. He said, hey, since the U.S. holds most of the gold anyway, why not just cross out gold convertible exchange and write in the U.S. dollar? And the room agreed. The U.S. dollar became the default central currency almost by sheer convenience. We're talking about a global empire built on the universal desire to skip a lengthy meeting. Moving on to the rise of the petrodollar. Decades later, a totally new system emerges when the dollar's original link to physical gold was finally severed in 1971. So following President Nixon's decision to suspend the dollar's convertibility to gold, a moment famously known as the Nixon shock, the world enters this new period of fiat currency. The dollar needed a new anchor, right? So it transitioned from being backed by physical gold sitting in a vault somewhere to being backed by the global insatiable demand for crude oil. The United States engaged in some very strategic diplomacy, particularly with Saudi Arabia, to forge this new reality. And this brilliantly illustrates the mechanics of what economists call petrodollar recycling. It's a highly effective three-step loop. First, oil is priced and sold exclusively in US dollars. Every nation on Earth needs oil, which means every nation suddenly needs dollars. Second, oil-rich nations take those massive dollar profits and reinvest them back into US assets, mainly treasury securities. Third, the US government uses this constant influx of foreign cash to finance its own deficits. This beautifully closed loop cemented the dollar as the world's primary reserve currency long after gold was out of the picture. Which leads us to the exorbitant privilege, because this structural dominance grants the United States a completely unique, massive economic advantage. The absolutely crucial point here is understanding this definition. Exorbitant privilege means global demand for dollars is so intensely high, since everyone needs them for trade and safety, that it actually crushes U.S. borrowing costs. Foreign investors are literally willing to accept lower interest rates just for the security and liquidity of holding American debt. It's a built-in financial advantage that no other country on the planet enjoys. To translate that privilege into actual money, a recent National Bureau of Economic Research working paper calculates that this exorbitant privilege is worth an automatic 1% boost to U.S. GDP every single year. Just by being the provider of the world's safe asset, the American economy gets a massive, continuous subsidy, transferred directly from the rest of the globe. Now, objectively speaking, this economic privilege also established an incredibly complex geopolitical web. It tied U.S. military alliances and security guarantees in oil-producing regions directly to financial flows. It allowed oil-rich states to accumulate to staggering wealth while simultaneously creating a deep, structural global reliance on American financial stability. the entire world's economy became completely entangled with the dollar. Section: Signs of Dollar Erosion. Because here's where the story shifts. Recent, hard economic data proves that this once ironclad system is starting to show some serious, quantifiable cracks. Take a look at this. Recent NBER research tracks the convenience yield, which is essentially the premium the world is willing to pay to hold U.S. treasuries over other assets. Historically, this premium is almost always positive. The world loved the safety of the dollar. But that dynamic is violently reversing. Recently, the convenience yield has absolutely plummeted, even crossing into negative territory compared to euro-safe assets. The world is suddenly demanding a lot less of a premium to hold U.S. debt. And that drop in demand isn't just theoretical. Actual ownership data confirms that foreign investors are aggressively retreating from U.S. public debt. In under a decade, the foreign share of U.S. public safe debt has plunged from roughly 45% in 2016 down to near 30% recently. That is a massive chunk of global capital quietly walking away from the American government's debt. This erosion is accelerating as nations neutrally but deliberately explore alternatives. We're seeing shifting global trade alliances, like deepening economic relations between Saudi Arabia and China. We're seeing the rise of decentralized cryptocurrencies offering peer-to-peer alternatives. We're also seeing BRICS nations openly testing independent payment networks, attempting to bypass the US-dominated SWIFT financial system entirely. Basically, the world is building lifeboats.
So, what if it falls? This brings us to the climax of our explainer. We've seen the history, we see the cracks forming in the data, but mathematically, what exactly happens to the global and domestic economy if the dollar permanently loses its reserve currency status?
Well, according to the macroeconomic models in the NBR study, without that exorbitant privilege covering the massive U.S. trade deficit, the math gets pretty brutal. The dollar would need to depreciate in real terms by 8.8% just to clear the excess supply of U.S. goods. That is a severe drop in the global purchasing power of the dollar. Plus, if foreign buyers aren't buying U.S. debt, somebody else has to. Because domestic investors would have to suddenly reabsorb roughly 50% of GDP in dollar bonds, the demand curve shifts violently. U.S. real interest rates would instantly spike by 90 basis points, nearly a full percentage point. That means mortgages, car loans, and business borrowing become immediately and permanently more expensive. When you combine a weaker currency with drastically higher interest rates, the impact is staggering. For you, this means everyday purchasing power drops while your borrowing costs surge. The researchers calculate that the total macroeconomic impact amounts to an aggregate wealth loss roughly equivalent to an entire year of the American economy's GDP. That is the literal price tag of losing the exorbitant privilege. So as we transition from a unipolar dollar empire into a multipolar financial world, you really have to ask yourself a question based on this data. How exposed is your own wallet to the end of America's exorbitant privilege? Because when the dust settles on this multipolar financial world, relying purely on how things used to be might just be the quickest way to lose your wealth. Thanks for joining me on this explainer, and keep questioning the data.